Good morning, everybody. Welcome to the Trading Market Technicals morning call video for Friday, December the 20th. Markets took a little bit of a breather. Dow Jones up 11, Nasdaq down almost 12, S&P down 1, just a little over a point, and the Russell down 8. Very, very common to have a pause day, inside day of price action from a big move up the previous day. Also, we are getting closer to the holiday season, so markets will tend to be a little whippy between the next, I'd say, the next 2 to 4 weeks, and I'd give it even a week or two going after the holiday, beginning of the new year, where people start to kind of come back into play and start revisiting their trading desks. So, interesting stuff, though. We're getting some interesting developments. I had a few questions, and I just wanted to kind of answer. I got a bunch of emails yesterday. Yesterday morning, I spoke about why I think that the builders might be a good spot, and I talked about the Volcker rule a little bit, and a couple people didn't understand it a little bit. So I just wanted to point out, here's one of the reasons why I like the builders going into 2014. And I mentioned also yesterday, the thing that can change is the interest rates. If interest rates start to really rise and go fast, obviously that sector is interest rate sensitive. So keep that in mind. And if you want to listen, you go into the YouTube channel and Trading Market Technicals, and you can hear what I said yesterday morning. But in a nutshell, why I like this so much is because if everybody recall the Glass-Steagall Act, which was implemented after the 1929 crash, and that really basically said that you guys meaning the banks, are not allowed to speculate in the stock market with deposit money. So what they said was they have to separate the two, and you cannot be traders and bankers or insurance brokers and stuff like that. So they actually separated the two and created the Glass-Steagall Act, which was also renamed the U.S. Banking Act of 1933. Okay, so that's basically that in a nutshell. Well, Clinton comes out in 1999. The Clinton administration, they repeal the Glass-Steagall Act. What happens? Boom. Banks are ready to start to trade again. They start trading. They start trading speculatively into the market. They create all these derivative products, and hence we get the crash of 2008. Then we come fast forward, and now we have the Volcker Rule. Now, the Volcker Rule is in effect, and what it does, it forces banks to do what the Glass-Steagall Act did. It forces them to lend. So they have to implement this aggressive lending strategy. And what that does, that's going to flood the real estate market with liquidity. So what's going to happen, you're going to get that speculative buying again, and you're going to get people looking to buy homes. Will interest rates rise? Well, they're rising right now, but it's not to a degree, not damaging pace that the markets, the real estate market is going to, come to a steady halt. I don't think so. That's why I like the banks, the builders. And I even like the banks. I mentioned many, many times in the videos that I do like the banks as interest rates do rise. That also helps the bank's bottom line. And we'll get into the charts in the chart segment. But that's the reason why I like the banking, not just the banking sector, but really we're pointing out the home building sector. I do like that sector going into 2014. And I think that you can actually start accumulating that sector. And I'll show you some stocks that I do like within the building sector on any pullbacks, any deep pullbacks, or if the market pulls back a little bit, you can start accumulating that. I do think that the real estate market is going to be a real good spot going into 2014, and it should accelerate going into 2015. Obviously, as long as there are no hiccups. So. Good spot. I just wanted to give you guys a little bit of a recap from why I like the banks, and I wanted to just kind of explain a little bit more about the Glass-Steagall Act and the Volcker Rule. But that's the reason why the real estate market is going to do, I believe, very well. And again, it's just an opinion, but this is something that I'm going to look deeper into, and of course take that opinion into a trade idea. Okay, so let's go into. I'm going to go right into this the indicators. Yes, the market is up. Yes, the markets are doing fantastic. And is Santa Claus in town? Possibly. This does not mean that it's going to affect the trading for today, tomorrow, or even going into the end of the week. But my concern continues to be that we have lower lows and lower highs. What this tells me as a short-term trader, I'm not a position guy, but if I do like to take positions via options and hold them. The reason why, which is concerning, is that as price is moving up, our indicators are telling us something different. So we don't have everything humming together. We don't have symmetry with indicators, price, and what the market is doing, right? So that is what's bothering me. And if that's the case, then I take a little step back and I say, okay, I'm going to take advantage of price in the very, very short term until these indicators that I'm going to show you can actually start to turn back up with price. Okay, that's how I use it. So we have the new highs, new lows, not making new highs and new lows. And yesterday, yeah, we had a little bit of a breather, so you're going to get that little pullback, but we're still making lower lows and lower highs. That's something that I do not like. Stocks above the 50-day moving average. We did get a little bit of a pullback up, but look what's happened. Even if we jumped up, we're still making lower lows and lower highs off of these little peaks here, these little short-term peaks. And again, we're at these levels where I think the market can actually push a little bit lower. Now, does it happen between now and next 2 weeks? Probably not. But does it happen in 2 weeks, maybe 3 weeks going into January? I would say it's a high probability that we get one decent sell-off, maybe two in 2014. And that's when you need to take advantage of that. Okay, so now we have the stocks above the 50-day moving average. Let's take a look at a tick. Tick again. Yes, we're above zero, but look what's happening. These little peaks, lower lows and lower highs, and we're barely at zero here. So not really a good sign here. So the internals are telling me something different than what price is. New York Stock Exchange 52-week highs. Again, lower lows and lower highs. Can't break this downtrend trend line. So now you got to take all this and digest and say, okay, well, you know what, let's take it with a grain of salt. But yes, let's not get too crazy about buying stocks that are at these all-time highs here. McClellan Oscillate, as you can see here, we're starting to kind of curl in here with the Bollinger Band. Okay, this is just telling me that we have plenty of room to run either way, up and or down, before we get overbought and or oversold. Okay, so we still have that. New lows. Look what's happening. And new lows starting to creep back up again. And there's a pattern of higher highs and higher lows. Definitely don't want to see that with new lows. New York Stock Exchange new lows. So we continue to make these new lows while the market continues to go higher. So a little disturbing here. The VIX. VIX is well contained. Obviously, we have low volatility. We have people buying the market. And I do think that the market does do well in 2014. But I do expect probably a scary pullback or correction in 2014. Again, not actionable until we see price confirm that. But do see something like that happening. Now, what's also interesting, as we talked about gold yesterday, I love gold short. I loved it up here, and as you can see, it doesn't get you in. And in my trading plan, I need to see some conviction before we get a reversal. So we had this move up. I wanted to see one more move into this neckline, into this 50, and we didn't get it. We just dumped. We had 2 days of consolidation, and then we just dumped yesterday, obviously after the Fed day, about its tapering. Now, do we short gold here? Absolutely not. You're not going to chase gold. If gold can have a good dead cat bounce, that's great. But I think gold is getting now, believe it or not, better being a buyer of gold than a short seller. 1176 here. If it takes that out, you're going to get a big flush, probably into 1,000. That's where I'd like to start nibbling gold, right around 1,000. Obviously, easy to manage, but I think gold is now becoming more attractive on the buy side than the sell side. So no trading gold unless gold can actually take a real good bounce up. Maybe retrace this whole candle, which I highly doubt it. But just remember, a better buy of gold, short seller back up at these areas here. Okay, so that's gold. Now, interesting developments is the dollar. Well, let's talk about the dollar first before we go into the bonds. The dollar here, as you can see, looks like it really wants to rally now. We had this big, long-legged doji, and now we actually came back up and we tested this. We took out that high. So we have an outside day price action in the U.S. dollar. So what can we say about the dollar? Well, if the dollar gains some strength, commodities will indeed go lower. Precious metals, obviously, for one of them. Also, the euro, and you go into some currency. So if the dollar continues to gain strength, I like to see possible euro short. You can go that with the FXE, with the ETF if you don't have a Forex account, or obviously look to short the euro dollar. But again, I need a little bit more. I'd like to see it run up one more time and then pull back and make that higher low off of this low here, that would get us above the 20 and the 50-day moving average. And then, of course, we have to contend with the 200-day, but that's a little bit away right now. So I'm looking for a possible euro-dollar short through the FXE. But again, we want to see a little bit more, maybe another move up and then a pullback, and look to see that next pullback. You want to get long dollar, again, do it through the euro. Okay. All right. So now let's go right into the chart segment. Here's the euro. The E-mini S&P hourly contract, hourly continuous contract. We're up about 3 handles right now in the morning, and we're just kind of hugging along here. So to me, this is very bullish. And if you see all the moving averages, they all have this bullish symmetry of moving higher. Okay, 1797 is going to be the first leg that it's going to really need to break down to break this bullish momentum to the upside. Okay, so I would be watching that in the coming sessions just in case. But other than that, the next spot's going to be 1820. I like obviously the original high of 1812, and then right up in here, 1812 will be the high, but really the next target after 1812 will be 1820. So that's something I'll be looking for in the coming days for the E-minis. Is it likely to get up there? I do think so. I obviously think that with low volume, no one really wanting to disturb the markets here, I think the markets are going to move higher, at least grind higher in a sloppy price action, because the markets are pretty sloppy right now intraday. Okay, so let's take a look at the TLT, and before that, let's go back to those bonds. Here's the weekly long bond, 30-year. We are now barely clinging to support. If we break this double bottom, next target is going to be in this cluster area here, this little supply area, 117, let's call it, to 122. And if that's the case, then we can get back at the TLT, which is very similar. As you can see, you can actually start looking at short TLT. I would prefer if it would let us in to get a little bit of a bounce, but if not, if we break this support, I look for the next back test here to get short the TLT. So liking the TLT on the short side. Okay, let's take a look at. Let's go into some other. Here's the daily chart of TLT. As you can see here, really basically just clinging on from August all the way up until the latter part of this year, looking to break down. And I do suspect bonds to continue to break down. And now let's talk about the builders. Here's my favorite home builder right now is Lennar. Beautiful, beautiful. As you can see here, we really sold off pretty hard. We have this whole little support area from pretty much the latter part of this year, just consolidating this choppy formation. Now we get into the symmetrical triangle. Now we have this volume zone. We have the thin zone on the way down, and now we have a thin zone on the way up. This, to me, is probably one of my favorites. Big volume accumulation day 2 days ago. We have an inside day, and we have broken out of the symmetrical triangle. This is one of my favorites, and this is something that I will be looking for in 2014, looking to trade and accumulate in Lennar. Now, we have Toll Brothers, which is another good one, but not as clean as Lennar. Okay, we do have accumulation coming in. Now, this has not broken out yet. So if this starts to break out, I would look for the next back test. Okay, and then we have PHM, which is another one. Oops, excuse me. Actually, couldn't get that chart, but PHM is another one to look at. It's a lower price chart. I think I would prefer the other two, though, the Lennar and Toll Brothers. Lennar is the better looking chart, though, guys. If you're looking for something to trade going into next week, next year. All right, so let's just see. Let's go into oil. Crude, really looking fantastic. We broke above the 200-day moving average, and now sitting on top of it. Usually, if we get a break above something like that, we break back down again, at least to kind of test it. Again, can you buy it? Yeah, I believe you can. You can take your stops below here. I'm just going to be a little more patient in crude and look to buy it on a deeper pullback if it can get to maybe the 20-day or in between this area here. I think I'd be a better buyer than looking to just kind of test it, especially coming to the end of the year. Okay, and then we go into the GLD, as you can see here, really broke this area. Now we're literally clinging to this low in July. If it takes that out, then I think all bets are off to, and you're going to probably see 110 to 108 in the GLD. Here's the spiders going into that inside day, but again, very healthy that the market's paused, and I think the spiders are going to make new highs going into the end of the year. Same thing with the diamonds. As you can see, diamonds actually did make new highs. Apologize for that. Diamonds did make new highs yesterday, all-time highs. So really starting to kick in here. And if you see the other indices starting to pull together and chugging along, I think it's going to be. I think you're going to have at least one or two big up days going into the end of the year. Same thing here with the transports. Our leader had an inside day, very, very quiet, but looking like stocks like Boeing, UPS, FedEx, some of the bigger stocks within that sector, they're all moving much higher, and that's going to take the transports, this indices, along with it. So again, if that's the case, you see some of the bigger components moving higher in the IYT. I think you're just going to have the other ones start to move higher as well. Again, which would bode well for risk-on appetite. IWMs took a little breather, no problem. Still hanging up the upper end of the range, holding at 20. And again, target for the end of the year would be the upper end of this trend line here. XLF, remember, I still like the banks going into next year as well. And just to show you, Goldman Sachs took a little bit of a breather, a little doji now. Now probably looking for a little bit of a rest, maybe a little bit of a pullback here. But Goldman here, to me, is done. But I like JP Morgan. As you can see here, JP Morgan had a decent day, follow-through day. We did ended up breaking higher and then pull back a little bit. But I do like JP Morgan long. That's one of my better picks for 2014 is the banks. Again, talking about that lending, the Glass-Steagall Act, the Volcker Rule. Banks going to have to get aggressive. And again, higher interest rates help the banks out. IGN, technology's been a little quiet. Here's a networking sector, but this sector within the tech is a little quiet. Apple itself had a little bit of a pullback again, and here's going to be a good spot to look to get in here. If you're looking to get into Apple, here it is. You got this uptrend line. You're below the 20 though, but you're still above the 50 and the 200. You're coming in some good support. So here's the one spot here if you're looking to get involved. Easy to manage. I like to see, maybe a little more of a whoosh down and then hold the 50 and then get that bounce play back up again. And lastly is the Qs, as you can see here. Pretty much whatever Apple does, the Qs kind of do as well follow. And we're below that trend line, okay? So technology kind of quiet, but remember, guys, keep an eye. We got a lot of good stuff going into 2014. There's going to be a lot of great opportunities. So just a quick recap. I'm looking for a euro short, home builders long, gold, looking for a better buyer in gold. Obviously, USO, looking for a pullback in the USO, and of course, looking to short bonds. And again, be patient. Let it come to you. It will happen. Have a great day. Enjoy the weekend, and we'll have a big report on Monday. Take care.